This is an overview of the Polaris provided free investment applications. This video discusses how the different applications fit into the investing life cycle. This video is brought to you by PolarisInvesting.com, a website for creating defensible valuations. Keep in mind that business valuation is based on expectations derived from skillful consideration of past facts and future possibilities. The Polaris investing applications consist of portfolio return spreadsheet, which is primarily for tracking investment performance. The Polaris valuation spreadsheet, which is actually a companion to the Polaris website, that's, as its name implies, is for creating defensible valuations. Have the SP500 Analyzer spreadsheet, that's primarily for price monitoring. Stock liquidation spreadsheets for order execution. Its default configuration is for selling, but it also can be configured for buying. We have the trade management system spreadsheet, a special situation of buying and selling. In addition to these 5 applications, there are also a spreadsheet that was introduced in a finance topic video for personal tax planning. Each of these applications are discussed in detail on the Polaris Investing YouTube channel. Here in the free investment apps section, consisting of the playlist shown here. Right above here in the background section, there's a playlist called Finance Topics, and that's where you'll find a detailed discussion on personal tax planning. This diagram shows an implied sequence of using the applications. Although often in practice, a user jumps around using different applications as needed. At first, it seems logical to start using the valuation application or the Polaris website to identify stocks. Once stocks are identified, their prices are then monitored using the SP500 Analyzer application. Once target prices are reached, buy orders are executed using the stock liquidation application in buy mode. Finally, investment performance is tracked using the portfolio return application. Actually, it is recommended to first start with the personal tax planning worksheet, followed by the portfolio return application. Often before buying any stocks, it is necessary to liquidate or sell some existing stocks to generate cash, which would imply using the stock liquidation application. The following is a demonstration of using the applications in the sequence shown on the left side of the diagram. Okay, starting with the personal tax planning spreadsheet. You see here that this was filled out for somebody who is age 55 and shows their planned income and taxes leading up to retirement and through retirement. This column here shows the expected net cash that the individual is wanting to generate year to year, whereas this column here shows the amount of after-tax cash flow they expect to have. So the difference between those two columns is shown here. Now the spreadsheet assumes that dividends are reinvested, so dividends are not included in tax-free cash flow. The total reinvestment in a taxable brokerage account is dividends plus excess cash. So if you go here and look at the retirement account, see that total here in this column. The amount withdrawn from a taxable brokerage account is part of tax-free cash flow, and it's shown here in this column. The average cost basis of funds withdrawn from a taxable brokerage account is shown here, currently set at 50%. So if you take 50% of $35,000, you get $17,500, which is shown in this column as the reported capital gains for that particular year. If the withdrawal amount includes dividends, which have zero cost basis, that needs to be factored into the overall cost basis rate that's being applied to the total amount withdrawn each year. So looking at the taxable brokerage account and the retirement accounts worksheet, you see the withdrawals and the reinvestment. So for instance, the difference between age 55 and 56, there's about a $7,500 difference. And that's the difference between what was reinvested, excess cash and dividends, minus the withdrawals. In addition to reinvestment and withdrawals from the taxable brokerage account, the spreadsheet also assumes that during the working years, earned income is net of 401k and IRA contributions. Those contributions are shown in the retirement accounts, namely here for the traditional 401k, here for the before tax IRA, and then the Roth IRA contributions. If you assume 401k and IRA contributions are being passively invested, meaning they're likely just being swept into an SP 500 index fund or some other type of fund, then that leaves just the taxable brokerage account to be actively managed. This means as you go about buying and selling stocks in a year, you need to keep in mind the target amount of reinvestment, which also includes reinvested dividends, and the target amount of long-term withdrawals, and the associated long-term capital gains and targeted dividends to report. Now that we have some yearly investment parameters identified from the personal tax planning spreadsheet, I'm going to now go on and show using the Portfolio Return app in order to track investment performance. So the first thing you want to do is create a portfolio. So you select Create Portfolio. Now the name, since this is going to be for tracking the taxable brokerage account, I'm just going to use the name of this 55-year-old investor, and we'll call him Bob, his last name starting with H. So Bob H, and then underscore taxable. Next, it asks me if I want to associate a passcode with the portfolio, which I don't. Now that the portfolio has been created, looking at the View Journal worksheet, you notice there are no journal entries for a newly created portfolio. Next, going to seed the portfolio with an initial cash balance by making a journal entry using the Update Journal worksheet. I'm assuming there is $20,000 of cash currently available, so going to add that transaction. When returning to the View Portfolio worksheet, it gives you a reminder that you have to reselect the portfolio to see newly updated journal entries. Now, after I reselect my newly created portfolio, it'll come back and show that this portfolio currently consists of a single asset, namely $20,000 of cash in a money market. Let me go look at the View Journal, and it's just got the one entry in it. So the Bob H. taxable portfolio has been created, has an initial cash balance of $20,000. Next, going to use the valuation application to identify suitable stocks to buy. Before discussing the valuation spreadsheet, I want to briefly mention the Polaris Investing website. The website is good for straightforward valuations, providing 3 sliders, one for sales growth, another one for profit margin, and a third one for price earnings multiple. The valuation spreadsheet is much more comprehensive than the website. Before watching this demonstration of the use of the valuation application, it is strongly recommended to first watch this 10-minute quick start video. I'm going to use the candidate and the topical drop-down menus to discover stocks to place in the portfolio Bob H. underscore taxable. As suitable stocks are discovered, their tickers will be added to the Bob H. taxable portfolio. So to start, I'm going to make the blank Bob H. taxable portfolio by going out here to the Manage worksheet and selecting Y, putting a comment in here that this is the Bob H. underscore taxable portfolio. To guide stock selection, I'm going to use the following criteria. Quantitatively, company must have stable operations. It'll be shown here. Moderate financial risk is measured by the debt to equity ratio less than 2. Systematic risk is measured by beta, must be less than 1. Prefer to have a dividend shown here of at least 2%, annual expected return of at least 8%, and qualitatively looking for companies that have strategic competitive advantage, primarily a brand or a franchise, patents, intellectual property, and then a catalyst that would likely drive the price to the expected return. Let's first look at the topical list in the topical worksheet and see if there's any stocks there that on the surface look interesting. Conagra, Kimberly-Clark, and Coca-Cola look most interesting. Let's see if any of those 3 pass the criteria that we identified earlier. Here we are with Kimberly-Clark first, and you can see here that it is a stable company. Debt to equity ratio is extremely high, so I'm not going to pursue it. The next one is Conagra, and you can see here it's stable, very low debt to equity. Beta looks good. It has a high dividend. Expected return is 15.8%, and qualitatively has a good brand, and can't think of any specific recent impactful news. Overall, Conagra is a go. To quickly add Conagra to the portfolio, just need to select cell C2. You can see here it gives you a message that's being appended to the Bob H. taxable portfolio. You agree to that and you say yes. If we go out there and look on the Manage tab, you can see here that in column Y we've got now 1 stock associated with, namely the one we just selected, Conagra. So let's go down and look at Coca-Cola. You can see here it is a stable company, has a debt-to-equity ratio below 2. It's got a reasonable beta of 0.7, does pay a good dividend. Annual expected return is 10%, so that's above the 8% we're looking for. As far as strategic competitive advantage, strong brand. In Catalyst, don't know of anything in the news recently, but it's the overall Coca-Cola as a go, so I'm going to add it to the portfolio. Another thing you can possibly do is you can select over here template. You can see here some suggested things that you should comment on further. And then if you want, you can save off this entire analysis, and so the next time you bring up Coca-Cola, you don't have to rethink through everything. But I'm not going to type in and save a narrative now. Okay, next I'm going to switch over to the candidate drop-down list and go look at the current candidates based on this query here. Now you can select other queries to run and even modify the query. And I'm going to go ahead and refresh this query. And without doing all the analysis, I'm just going to pick a couple more stocks to add to the portfolio. So I'm going to go with Honeywell and Walgreens and Walmart. So come back here to the valuation worksheet with the candidate menu selected. They're going to pick Honeywell, add it to the portfolio, select Walgreens, add it to the portfolio, and then Walmart, add it to the portfolio. All right, then when we go over here and look at our portfolio, we see we have 5 stocks. Okay, now that we've got 5 stocks identified, next going to use the stock liquidation spreadsheet in buy mode to keep track of purchasing the stocks. When the stock liquidation spreadsheet is first opened, it is in the liquidation mode by default. So you change it to the buy mode, and then we're going to add the tickers that we decided to purchase. And then select cell G2 to update ticker and price information. Next thing to decide, what is this total amount of investments going to be made across these 5 stocks? This takes us back to the personal tax planning spreadsheet. The plan for the year was to invest $42,574, consisting of $30,000 of dividends and $12,574 of excess cash, and withdraw or liquidate $35,000 throughout the year. Now, one approach would be to only invest the difference of $7,574, but it is advised to think about investing and liquidating separately. Invest when cash is available and liquidate when cash is needed throughout the year. It is going to be assumed there is $15,000 designated for current investments. The $15,000 will be invested evenly across the 5 stocks, resulting in the following number of shares per stock. Now, it's unlikely that the valuation and expected future return of stocks is the same that was determined when you did your valuation, so it's important to transfer over your own valuation and expected return from the valuation spreadsheet to this spreadsheet. Now, assuming that you're comfortable with the overall portfolio expected return of 9.55% across these 5 stocks, you would then place orders at either the current price or do some kind of a limit price for price around the current price, because the returns are based on the current pricing. So as long as you can get an order executed around the current price, you will achieve the 9.55% if things work out in the future as you expect. So in this spreadsheet, what you do when the order gets placed, you put in the amount that you've done, let's say, the limit order for. And once all the limit orders have been placed, you wait for the orders to be filled. And as the orders fill, you put the date the specific orders were filled. Make note of the order date, the ticker, the number of shares, and the order price in order to enter in the portfolio return application. And the last thing is to save off the spreadsheet using a name that makes sense. And we're going to call this the buy of the Bob H. taxable. Okay, next we're going to return to the portfolio return app to enter the now 5 fulfilled buy orders. To enter the buy orders, go to the update journal worksheet, enter in the 6 transactions, the 5 buy orders, and then have to record a transaction for the cash that's being used for the purchase of the 5 stocks. After adding the 6 transactions, you'll see here that now in the view portfolio, you see the updated cash balance and now the 5 stocks that were purchased. Go to the view journal and you see each journal entry. All right, next we're going to use the SP 500 Analyzer to monitor prices. So the first thing we want to do here in the SP 500 Analyzer app is down here in the watch area is we want to enter in this portfolio that we just created. So to do that, we'll start off and just switch to a watch list of none, and that'll blank out the watch list area. I'm going to enter in the tickers from the new portfolio. And then once those tickers are entered, we want to come up here and do a refresh. And then we want to come over here to shares and enter in the number of shares purchased. Next, we want to come over here and enter in the target return that we're hoping for going forward. Now with all that entered, I want to now come up here and do a save. And we're going to call this Bob H. Taxable. Okay, you see that it's been saved, which means it's been recorded on the saved list worksheet. In fact, if we go out here and look at the saved list worksheet, you'll see it. But it doesn't mean that it's permanently saved, because that won't happen until you save the worksheet. So it's probably a good idea to go out there and save it. Now that the portfolio has been entered into the SP 500 Analyzer app, you can open up the app whenever you want to check on the current prices. Also, and by default, it'll always show you the price change from the previous trading day. But if you want to go back further in time, you enter in a different date up here. Using the SP 500 Analyzer spreadsheet is very convenient to compare price changes in your portfolio with stocks in the S&P 500. Also up here you can look at how your portfolio is doing against specific sectors. Now if you want to drill down even further into these sectors, you can go over here to the industry worksheet and select specific industries within a sector. The S&P 500 Analyzer app, like all the Polaris Investing apps, has a GraphPrices worksheet. Now here in the S&P 500 Analyzer app, the GraphPrices drop down here in cell A1 shows the tickers from the watch list area on the S&P 500 worksheet. Recall, graphing is a 2-step process. First you select the ticker, and then after the prices have been updated, then you select graph. All right, the last application we're going to discuss is called the Trade Management System, TMS. The example sequence of using the Polaris Investing applications that we just went through was based on buying and selling on valuation. It's also known as fundamental analysis. TMS is a technical analysis approach that is based on price movements. TMS requires order execution, performance tracking, and price monitoring, so the stock liquidation, portfolio return, and S&P 500 Analyzer apps are useful for this approach as well. Like the Valuation App, investment success from the TMS app is highly dependent on the stocks selected. TMS is a bet that past favorable price movements will continue into the future. Ideal price movements are a pattern of offsetting short runouts. This ideal pattern is shown here in this diagram. And when you have, in this case, starting off with an increase in price, but for only a modest change or a short run out, and then it turns around and now decrease, increase, decrease, and each time you're buying low, selling high, buying low, selling high. It is unrealistic to think prices of any stock move in such an idealistic pattern, and that there are obvious buy and sell points. But it is possible to identify stocks whose historical prices zigzag with minimal net price change from the start of the period to the end of the period. Buy and sell points can be determined by finding a constant percentage increase and decrease that maximizes return. The stock screen worksheet allows you to run a query that identifies potential stocks. To find the buy and sell price point that maximize return, select maximize return on the Portfolio Analyzer worksheet. Now before I run that, I'm going to refocus the maximization to maximize the return for the specific stock, AEP. So now I select maximize return to run it. And then when it's done, it shows the maximum return, in this case for the stock AEP, and then the percentage decrease and increase for the buy points and the sell points. Now if I select yes, it'll automatically use those determined values. You can see here for AEP we now have a return of 13.7%. To further test, I'm going to use the RandomWalk worksheet to generate random prices that are normally distributed based on the stock's historical mean return and standard deviation. Only price sequences that with short runouts are used. This will essentially test the resiliency of the model parameter settings. Each time I hit execute, I get a different sequence of random prices. If A4 has previously been set to weekly, GraphPrices worksheet can be contorted to show prices for the RandomWalk worksheet. This is done by referencing cell F4 in RandomWalk worksheet in cell C2 and then copying the formula down through column C. Then select A7 to graph the prices. Also shown is the annual return if you simply buy and sell at the end of the period. Right above that is through all this buying and selling, you would have achieved 8.5% annually. If the GraphPrices worksheet is set up to show RandomWalk prices, select cell C1 to get a new sequence of random prices. Then to select cell A7 to have them graphed. To return GraphPrices back to its normal behavior, select cell A20 to retrieve historical prices, and then A7 to graph them. This has been an overview of the Polaris provided applications that are used throughout the investing lifecycle. Thanks for watching.